Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Now, let us get into it. Marcus had been investing for 3 years when the earnings report dropped. He opened it. 47 pages, revenue on page 4, a table he did not understand on page 11, risk factors that went on for 9 pages. By the time he got to something that looked important, the stock had already moved 8%. He had no idea why. That is not a research problem. That is a framework problem. Most retail investors approach an earnings report the way someone approaches a legal contract. They read everything. They understand nothing. They make a decision based on how the press release headline made them feel. Here is the truth. A quarterly earnings report contains exactly 5 numbers that tell you almost everything you need to know about a business. Not 47 pages worth. 5 numbers. If those 5 numbers are moving in the right direction, the story is intact. If 1 or 2 are breaking down, you start asking harder questions. If 3 or more are deteriorating, you have a thesis problem, not a noise problem. Let us go through each one. Number 1, revenue growth rate. Not revenue, the growth rate. The number itself tells you the size of the business. The rate tells you whether the business is accelerating, decelerating, or dying slowly. What you are looking for is consistency and direction. A business growing revenue at 15% for 6 consecutive quarters is telling you something structural. A business that grew 20%, then 18, then 14, then 9 is also telling you something structural. Both stories are written in the revenue growth rate. Most investors only read the headline number. The question to ask is not how much did they make. The question is how much faster or slower are they growing compared to last quarter and last year. That comparison is where the signal lives. Number 2, gross margin. This is the percentage of revenue left over after the direct cost of delivering the product or service, not after paying the CEO, not after marketing, after the core cost of making and delivering what they sell. Gross margin reveals the fundamental economics of the business. A software company with 80% gross margin is structurally different from a retailer with 30% gross margin. Neither is automatically better, but you must know which kind of business you own, because margin tells you how much leverage the company has over its own growth. What you are watching for is direction. If gross margin is expanding quarter over quarter, the business is becoming more efficient as it scales. That is the compounding mechanism at work. If gross margin is compressing, the business is working harder to generate the same dollar. Something is wrong with the pricing power, the cost structure, or both. Number 3, earnings per share versus the consensus estimate. The market does not price in what a company earns. The market prices in the gap between what a company earns and what analysts expected it to earn. This is the single most misunderstood dynamic in retail investing. You can own a company that grows earnings 20% and watch the stock fall on earnings day. Not because something went wrong, because analysts expected 25% and the company delivered 20. The gap was negative. Marcus learned this the hard way. He held a technology company through a strong quarter. Revenue up. Profits up, stock down 9%. He sold in confusion. 3 months later, the stock was 30% higher. He had read the numbers correctly and misread the signal entirely. What matters is the beat or miss against consensus. A company that consistently beats analyst estimates by a small margin every quarter is building a track record of credibility. The market rewards credibility with a higher multiple over time. A company that misses estimates even once after a long streak of beats will be punished disproportionately because credibility lost is harder to rebuild than credibility built. Number 4, free cash flow. Earnings per share is an accounting figure. Free cash flow is real money. It is the cash that actually flows into the business after all operating expenses and capital investments are paid. It cannot be manipulated the way earnings per share can. Depreciation schedules, amortization charges, one-time adjustments, all of these can distort reported earnings. Free cash flow strips most of that away. A business that reports growing earnings per share but declining free cash flow is waving a yellow flag. The earnings look clean on the surface. The cash generation underneath is deteriorating. Follow the cash. The cash does not lie the way accounting can. What you want to see is free cash flow growing at a rate that roughly tracks or exceeds revenue growth. If revenue is growing 15% and free cash flow is growing 20%, the business is becoming more capital efficient. That is a quality signal. The compounding engine is getting stronger, not weaker. Number 5, guidance. The first 4 numbers tell you what happened. Guidance tells you what management believes is about to happen. Guidance is management's public commitment to the future. It is the number they are willing to sign their names to in front of institutional investors, analysts, and the financial press. When a management team raises guidance, they are telling you confidence has grown. When they lower guidance or pull it entirely, they are telling you something they know has changed. The most important guidance signal is not the absolute number, it is the direction of revision. A company that started the year guiding for 10% revenue growth, revised to 12% in quarter 2, and is now guiding for 15% in quarter 3, is telling you the business is running better than they expected. That is a series worth watching. That is a business where the story is getting stronger in real time. 5 numbers: revenue growth rate, gross margin, earnings per share versus consensus, free cash flow, guidance direction. Every quarter, before you read anything else in an earnings report, find those 5 numbers first. Build a simple table: last quarter versus this quarter versus this time last year. 3 columns, 5 rows. That table will tell you more than 47 pages of management commentary. Here is what the table cannot tell you. It cannot tell you whether the business grip is still intact. It cannot tell you whether the industry structure is shifting underneath the numbers. It cannot tell you whether the accumulation pattern in the stock is confirming or contradicting what management is saying. That is what the clear framework is for. The 5 numbers are your first filter, not your final answer. Most investors make one of 2 mistakes with earnings. They either ignore the numbers entirely and trade on the headline and the price movement, or they drown in the numbers without a framework to interpret them. Both approaches produce the same result: a lot of activity and very little understanding. The investor who wins over time is not the one who reads the most. It is the one who reads the right things in the right order with a framework that converts raw data into a clear verdict. Amateurs react to earnings. Investors measure them. Visit ProfitByFriday.com today. Subscribe free to the Friday Flash, where you will receive one stock fully evaluated through the clear framework every Friday, so that you know everything about the company before you decide to invest. No noise, no hype, just the analysis that matters. We trade for cash flow. We invest boring to build legacy. See you in the next episode. Bye for now.